Hello, everyone, and welcome into crushthestreet.com. I'm Kenneth Amaduri, and I'm joined today with a very special guest, David Mcalvany. David is the CEO of Mcalvany's ICA, a precious metals brokerage that was established in 1972. He's also a well-respected thought leader on the global economy and author of The Intentional Legacy, his thoughtful memoirs and musings on the power of legacy and family culture. I love that. He talks about his kids. He talks about his family. If you listen to his regular market wrap-ups, and that's something that I'm very much interested in, especially having young kids going into this new turning, which I believe we're going to be talking about today. Let's chat about metals. Let's chat about the markets. Let's chat about what's going on in society. So, David Mcalvany, thanks for coming on Crush the Street with me today.
Hey, great to be with you. And I think it is important that we keep current events in perspective and be aware of not only the present tense, but also the future tense. When we have opinions of what's happening today, it needs to be with the idea that there's consequences that are born well into the future. A good friend of mine sent me an email last night, and he said, okay, so this issue with the national debt, it continues to escalate. Isn't this really a burden to future generations? And this was a new idea to him. But of course, for anyone who's looking at fiscal policy, monetary policy, these kinds of things, yes, absolutely. We are creating burdens for the future. So we have to weigh them in terms of their real cost. And even if we're not the ones to bear the burden, if we're not sensitive to our children or grandchildren, I think we can make significant mistakes along the way. So this is where I think legacy and finance and economics, they all are very well intertwined if we're going to think well and act well in that context.
Yeah, and I hate to throw it in there because not a lot of people want to acknowledge this, but politics as it pertains to our money, I mean, it's all tied in, and it's a kind of an unfortunate thing, but that's the world we live in. But let's start here. And this is something that you brought up in your last wrap up. We've seen one of the best months in the markets for stocks, but it also happened to correlate with one of the worst months that we've seen in the dollar in terms of a decline. So let's kind of start there. Your thoughts on that, and maybe as it pertains to what you alluded to in the introduction here.
Yeah, the currency tells a very interesting story. The currency tells you what people really think of the stock of the United States, and if they're coming into the US dollar or exiting the US dollar, and there's evident pressure within the currency markets. So yeah, we had the worst, I think the worst in August for the dollar since 2005, the best performance in US equities since 1986. So it was an extreme divergence. And I think you're going to ultimately be able to say there was a cost being paid for the success in the stock market. And yes, currency is something that people don't generally look at or think about. They'd much rather say, hey, we're doing great. Look at the stock market. It's going to new highs. And on that basis, everything must be well. But in fact, the purchasing power of your dollar and every dollar you earn being worth less, I think that's of equal or greater consequence if you're looking at your total earnings, total spendings, and total life commitments. So a very important point you make.
Yeah, absolutely. And let's acknowledge this. So talking about a weak dollar versus a strong market, could that be the story going forward? And if that's true, do you believe the stock market to be a hedge against the dollar or inflation?
Yeah, typically the stock market has been a hedge against inflation, and it works that way unless you get into a super inflation or a hyperinflation, in which case the deterioration of the underlying currency exceeds any increase that you have in the markets. And so, yeah, I think if you're looking at historical studies of inflation, equities were not a bad place to be. Now, there's a whole different set of constraints in this particular environment because equities are supposed to reflect the activity that's happening in the economy, corporations in terms of sales and earnings, and we don't really have an optimal environment for sales and earnings. What we have is really a pass-through from easy money, the Fed, and their QE programs, and that emboldening speculation. And you know, it's fascinating in this particular cycle, what I think is very late cycle, both for the credit markets and the equity markets. We've seen a huge increase in the use of derivatives. The huge increase in the writing of calls, the buying of calls, these are options, and that form of derivative trading has absolutely gone bonkers. And it actually is very reflective of what we saw in the last half of 1999, where people who really didn't know what they were doing were taking outlandish bets on short-term gains. And it became really a place for speculation and gambling more than it did investment. And I think that's what we're seeing right now is an expression in the financial markets of casino-like characteristics, not exactly a place where you go to invest capital to see it grow conservatively over time, because companies, their boards, their management are doing an effective job of managing corporate assets quite differently. This is a little bit like roulette.
Absolutely. And it's interesting the cycles that we've seen throughout the year. 2020, we started the year with the economy seemingly strong, things normal. And then obviously going into the pandemic, the fallout, the crash that happened in the markets, the volatility. And then coming out of that with the reaction that we've seen from the Fed and the government, the Treasury, throwing trillions of dollars at the system. And the uncertainty that we saw through the summer, obviously precious metals did very well. And I want to get your thoughts on precious metals, but also I want to acknowledge where we are right now as we do this interview. Stocks are all-time highs once again. So that was a problem back in 2017, 2018 to a certain degree, where people were not buying precious metals. They weren't concerned about the economy because stocks were at all-time highs. So address maybe where we are right now. And do you believe this stock market at new all-time highs here is going to continue to put investors at ease and create this environment where people disregard gold and silver once again?
There's the possibility that with a zero or negative interest rate environment, we're looking at a period of time where all stocks get revalued to much higher levels, and that is a possibility. I think we've seen precious metals and stocks move up at the same time, one for good reason, one for bad reason, in the sense that stocks are moving higher because speculators are emboldened by the quantities of free money that are floating in the system today, created by the world central banks. $5 trillion from the world central banks, $18 trillion coming from the world's governments in terms of fiscal policy spending since the beginning of the year. That's a lot of money, a whole lot of money. So stocks like that idea. Precious metals are indicating that there's enough investors who say, yes, but there's a consequence to this. There's a consequence to that amount of liquidity coming into the system. And so, while one group is partying and saying, gosh, this is fantastic, easy money is great, another group is saying, I know, but still, there's reason for sobriety. If we look onto the horizon, isn't there a consequence to this? Couldn't we see a movement in the credit markets, higher interest rates, higher inflation? And sure enough, we have the Fed just in recent weeks saying we're actually going to target a higher average rate of inflation. It's not just going to be a 2% target. It could be any number above 2, and ultimately maybe we'll get to 2, but we may be at 2.5, 3, 3.5, 4, 4.5, 5 to get to our 2% target, overshoot. These kinds of things are factoring into investors' sense of uncertainty. And I think, frankly, that's why precious metals have been moving. You have political uncertainty. 2020 is certainly a contentious environment in that sense. You have geopolitical uncertainty. You look at former countries who either had strong trade relationships or strong international relationships with, and our foreign policy has been in tatters. So there's geopolitical uncertainty, there's political uncertainty, there's economic uncertainty as it relates to COVID. And I think, frankly, there are a number of internal fractures within the financial markets, distinct from the economy, sufficient that sophisticated investors look at gold and say, I think I need to hedge my bets. If they're going to be printing or creating trillions, just on the off chance that inflation gets out of control, I think I want some insurance on that. So on the one hand, you see both of them moving at the same time. Traditionally, that's not the case. Traditionally, stocks go lower, gold goes higher. They're kind of moving in opposite directions. What I think you'll see over the next 6 months is stocks trade lower and gold continues to trade higher, as sort of confirmation that, yes, there was a lot of risk out there. And now it's obvious for the investment community to see. And now they're responding with their feet, traffic out of the equities market and even more traffic into the precious metals.
Yeah, David, it's interesting. And my goodness, you articulated that so well. But it's interesting to me how, you know, the mainstream average investors, just people in terms of sentiment, they don't understand sound financial Austrian economics. They're not reading Mises and all these different things, sound money. And it's just to that extent, how much more can the Fed and the governments do to continue to string things along, as unsound as it might be, as much of a house of cards as it is, you know, direct deposits straight into accounts, negative interest rates, you know, buying stock on the open market, who knows what else, bail-ins, bailouts, that would seem like end game scenarios to, you know, a lot of people like me personally. But who knows, maybe that continues to kick the can down the road another 5 years, 10 years, and people think it's good. It's just, such a crazy environment. I've seen things happen so much and so extreme that have held things together, at least on the headlines. Your thoughts?
You know, I think so much of this has to do with mood, and the mood is positive today. They realize, the Fed that is, realizes that if they can influence mood, they can influence the market. And so it goes back and forth. If they lose control of the market, then they lose control of mood. And then it has a major impact on your economy, because people start tightening their belts and things. So they're trying to influence mood by painting the tape, by creating an atmosphere where, you know, you're always going to see higher prices in equities. That's the impression that they're trying to create. And so from a numbers standpoint, you may say it just doesn't make sense. But this is beyond numbers. This is beyond math. This is in the realm of psychology, where if you can influence people's belief about the environment they're in, then you can create a self-perpetuating reality. And so that's essentially what they're doing, is they're buffaloing the psychology of the market. And if they win, they may win for 1 year, 2 years, 5 years. Who knows how long they can maintain confidence? One thing we know from history is that confidence is very frail. And when it breaks, the Fed's idea that they can control and influence all of a sudden becomes what it always was: fiction. It's fiction. They win today. They may win tomorrow. But when mood shifts, I think all of a sudden the Fed says, you're right, we weren't actually in control of the market. That was called manipulation. And we weren't manipulating, well, we were manipulating the general public. And that's really what's at stake here, is a grand confidence game. Confidence in the treasury market, confidence in the stock market, confidence in the dollar market. And to the degree that they are painting a tape with stocks, I think this is where you have to look at the currency market and ultimately certain sub-indicators within the credit markets, whether it's credit default swaps or, you know, what it costs to insure against default. That's what a CDS is. And these give you some indication of smart money in the market who says, it's worked to this point, it's not working anymore. I'd like to be the first rat off the ship. I'm not going to wait for it to capsize. And so I think that's where it certainly has my attention. The dollar's been under pressure, even as stocks are hitting all-time highs. And gold is one of those other indicators. Inflation as well is showing up in, you know, copper, lumber, silver. These are all, again, sort of confirmations of maybe there's going to be a little bit more inflation as a consequence of all the schemes that have been put in place.
David, and I'll ask it to you this way. Has the price of gold moving up surprised you one way or another? Either underwhelmed or overwhelmed in the sense of, has it moved higher than you would have expected, or not enough in terms of what we've seen happen in 2020? My goodness, with what we went through in March, the response from governments, would you have expected an even higher price maybe?
On our asset management team, one of the things that we often repeat is that we're never prepared for what we expect. So yes, we've been expecting higher gold prices, and then here it is all of a sudden. You know, and I think that's the nature of the markets. You have to be a little bit early in some regards, because while you might expect it, it can take longer than you think. And then all of a sudden it's in the rearview mirror. And so here we are at 2000. We have a significant gain to digest, but I do think we have much more of a gain ahead of us. An inflation adjusted price for gold of, say, between 2,600 and 2,800. If you're talking about a very realistic inflation number, I think you're capped at probably twice the inflation adjusted price. And so if you said, well, what's my long-term projection, say 3 to 5 years, I think between $4,000 and $5,000 gold is about where we can cap out. Now that's assuming that the currency, the dollar, doesn't just absolutely go into the toilet. If we circle the drain with the currency, all bets are off in terms of the price of gold, because all you're doing is reflecting how many worthless pieces of paper it takes to get something that has real value. And you look at gold priced in Japanese yen, look at it priced in rupees, you start getting into the thousands, tens of thousands, even hundreds of thousands of currency units for an ounce of gold. Well, it tells you a long-term story about the value of the Indian rupee and the yen. And I think ultimately that'll be the story for the US dollar too. So we may have this transition point where we think of a normal price for gold and it's capped at $3,000, $4,000, $5,000 an ounce. And then if we do experience some form of currency carnage, then all bets are off. Yeah, it may seem crazy to talk about $100,000 gold, but all you're really talking about is a decisive extinction event for the dollar as we've known it.
Many people refer to the fourth turning, the book, and especially with what's going on right now. Maybe it started in 2008, maybe it's 2020. I'd like to get your thoughts on this. It seems so relevant and it articulates where we are today in society. The fourth turning, of course, when we reference the book, being the crisis turning in Americans' institutional lives, being torn down and rebuilt from the ground up. And so what are your thoughts on this?
I think it's a helpful model for seeing events and placing them in a broader context. And it brings in not only public policy issues, but economic issues, sociological issues, et cetera, et cetera. So what I like about Strauss and Howe's book, The Fourth Turning, is that it gives you that perspective on 600 years of British and American history, where you can say, okay, roughly every 4 generations, roughly every 100 years, we're in a big mess again, and we're at the end of a cycle. And these are political cycles, these are social cycles, these are also economic, financial, and credit cycles. They tend to overlap, and as you move into a crisis phase like the fourth turning, you end up seeing tremendous amount of discontent. People say, I don't like the system, it's not taking care of me. Maybe we saw that with the Wall Street protests, and this goes back to 2006, 7, 8, and 9. Maybe you see that on the streets today. But certainly, starting after the global financial crisis, there was much more of an expression of populism. And it wasn't just in the United States. It was the Five Star Movement in Europe. It was Syriza. It was all of these different populist parties popping up. Europe, Asia, America. And really what it's suggestive of is, again, that the credit markets have driven so much growth. And that growth has been disproportionately beneficial to certain people, that you've got a bunch of actors in society saying, this may be working for you, but it's not working for me. We're going to have to re-engineer this. Okay? And that's when policy starts to change. That's when politics starts to change. And that's when actually some really significant events can occur. In the fourth turning, they describe these events ultimately as moving towards something that's really not pleasant, whether it's internal revolution or external war, where politicians have played the blame game, and you're able to say, well, they did this to us, we're going to do that to them, and you end up with a real hot conflict. That is, I think, more and more probable by the day. You look at our relationship with China, it wouldn't surprise me. It could be internal, it could be external. Imagine this. Donald Trump wins the election. Do you think that the riots and protests that we see today in the streets are going to diminish through the months of December and January if Trump is reelected in November? I mean, this is again where you have social fracturing, a tearing of the social fabric, and this is the encouraging part, Kenneth. And I think again, this is where how can any of this be encouraging? Because these things run in cycles. They run in cycles, and just like a credit cycle, just like Schumpeter used to say in economics, there's a process of destruction which ultimately is creative. There's something that comes out of it which is almost cleansing. It sets the stage for the next era of growth. And those eras of growth can be spiritual growth, social dynamism. It's not just financial and economic growth. These are, and this is again, the fourth turning lays this bare, where you have all of these categories of a restart. And that's not negative, not in their view. And if you gain comfort from 600 years of history and sort of seeing these repeating patterns, you'd say, well, I guess it wasn't the end of the world when they were encountering the War of the Roses. It was a long time ago. And here we are at the end of another fourth turning. This is not the end of the world. Now, you do have to mind your P's and Q's. You don't want to be, you just have to be careful.
Sure. And it's interesting to talk about that cleansing moment where society rebuilds itself from the ground up. And I wonder, though, if it's going to happen in any sort of a meaningful short to midterm time frame where I can actually be optimistic about. And I just feel like, honestly, socialism, the media will only get stronger during these crisis moments. And, it's the old saying, never let a good crisis go to waste. And I just see, I have a very hard time imagining a real cleansing happening without extreme socialism taking over and things getting worse. And I guess for something to really reset, how long would it actually take? Is it 10 years? Is it a time frame where my kids are now young and it'll be better when they're graduating or going into their adult years? I don't know, just some of my thoughts, because I don't want to be waiting for something to happen, as if I'm investing in the world to inevitably turn into an ice ball. That doesn't do anything for me now, right?
Yeah, and I think this is where, Kenneth, we have to stay engaged and committed to a particular positive outcome, because it's not as if a positive outcome is guaranteed. It's just that significant change occurs, and there is a new commitment to principles and values which have been absent in the third and fourth turnings. So in that first turning, consider it sort of a new spring after a long winter. That if I'm using their language correctly, it's new, it's fresh, it's alive. That doesn't mean that it's ideal. And I think the person who defines what that first turning looks like, what are the values that are being sponsored, what are the things that are being recommitted to? I mean, could that be something on the scale of sort of national socialism, communism? Yeah, it's radical change. It's a restart. It's not necessarily positive. So that's where I don't think we can be dismissive and say, well, this is all going to sort itself out and we're going to get a clean slate and it'll all be good again. No, actually, it takes the same kind of commitments that I think our founders had, where pledging their lives, their fortunes, their sacred honor, they were willing to put themselves into the mix and be involved in the business environment, starting businesses, influencing to the greatest degree they can their spheres of influence. This is one of the reasons why I wanted to, in the intentional legacy, say, what can you control? What can you not control? You can't control the direction of the world. You can't even control the direction of the country, let alone your state. Maybe you can, as you get to a smaller scale, in your own community. And then really what you can control is your own life and the people who are in that immediate vicinity. So why the intentional legacy focuses so much on family and family dynamics and sort of cultural ethos rather than just finance is there's all of these factors that are outside of your control, but your daily habits and daily choices and the kind of culture that you create does represent an extension of you and of your values into the world. And I think that's a place where instead of counting on top-down solutions, as we head into a first turning, we're talking about a bottom-up basis, a grassroots basis of what matters to us. Well, let's put that on display. Let's live it. Let's see that the next generation says, I like it, I love it. This was a beautiful way to exist as a family. I can easily recreate this. In fact, I think I can iterate and make it even better. So we're giving our kids and our grandkids something to invest in, take pride in, and move forward with, honestly, I don't know how to control a massive corruption in Washington. I don't know how to control the direction of the world and bring about world peace. These are very grand and noble ideas, but I'm just a guy. I'm just a guy. Now, fortunately, I have a wonderful wife and four amazing kids, and these are lives that I can directly impact. So at the end of the day, as much as I care about all of the things that we talk about in our commentary on a weekly basis, as much as I care about the assets that we manage for our clients all over the country, the gold that we've sold to clients, tens of thousands of them all over the world, billions of dollars out there that we've put into the metals market, what I really care about is what I can control. And as we head into a fourth turning, first turning scenario, guess what? I think this is where the rubber meets the road. I think this is where we can make a huge difference. And it really is important that we codify individually, we codify what is most important to us and translate ideals into actions. That I think matters.
Wow. Those are some great closing thoughts there. David, if you would share a little bit more about the precious metal brokerage, what you do and how you can help people, and obviously any more content that people can learn more about you, share it now if you would.
Sure, happy to, Kenneth. One of the things we started doing 13 years ago was a weekly podcast, and so there's 700 different versions of that, or we've done it a lot, and we want to educate folks. We want them to be able to make great decisions as it relates to their finances, and so that I think is a very helpful resource. We're willing to engage with anyone, not necessarily just the people we agree with, and the list of people we've talked to through a 13-year period is quite something. It's an expression of my continued education as a lifelong learner, and something that we invite our clients into on a routine basis. Weeklycommentary.com is a great resource. You can also find it at McAlvanyweeklycommentary.com, but then you have to know how to spell my name. So weeklycommentary.com is sufficient. In the gold space, we've done this for 50 years. We helped get gold legalized. It was January 1st, 1975. We entered the business in 1972, found a tax loophole, and then worked with a number of politicians to change the legislation that had been in place since 1933. So we've been innovators in the gold space, call us founding members of the gold community here in the United States. The privilege that Americans have to own gold, my dad helped make that possible. I'm very proud of that. We continue to innovate and change. In the mid-'80s, we were the first company to put gold into IRAs. That hadn't been done prior to about 1986. We created something I think very innovative this last 2 years called Vaulted. Vaulted.com is a way that you can save in ounces rather than in dollars. So it's considered like an alternative to a banking or savings account. Very easy to use, very easy to fund. Our partnership is with the Royal Canadian Mint, and you buy kilobars or some fraction of a kilo bar. And I wanted gold accessible to my kids. I wanted them to be able to save and put $5 into a gold account, or $20 into a gold account, or $500 into a gold account. And we've had everything from $5 to $5 million. I mean, it's a great program. The only source of gold in the world which is guaranteed conflict-free. That 20 years ago didn't matter. I think that matters today for the right reasons. So conflict-free gold. It is deliverable. It is allocated. That's vaulted.com. So innovative products, helpful educational resources. The book that you mentioned, The Intentional Legacy. There's lots of ways for people to get to know us, and we've been here for 50 years. This is a space we know well. Our asset management business we started in 2008. I had already been through one bull market, or bear market rather, with Morgan Stanley in 2000, 2001, and 2. So 2, 3, multiple bear markets, we love them. We love them. We made money in 2008 and 2009 on our asset management team. We've got one of the best asset management teams on the planet today. Super proud of that. Yet another resource we offer. The Credit Bubble Bulletin has been written for the last 20 years by one of my colleagues, Doug Noland. He's on our team and helps manage assets with us. And we provide all kinds of things. Hard asset insights, a weekly wrap up on the markets, the Credit Bubble Bulletin, the weekly commentary, Golden Rule Radio. We've got all kinds of resources, and easy enough to find us on the internet if you're looking and want to work with good people.
David Mcalvany, everybody. David, thank you so much for coming on Crush the Street and sharing your knowledge with us.
Great to be with you. Thanks for the invite.